everyone. I'm David Darst here to give you a recap of the month of May, which certainly had a lot of upward and downward movement, a lot of news developments. The S&P 500 was up 6.2%. As you know, it was up very slightly in April, 0.8%, after being down big in March. April had the Liberation Day, things fell down, then they went back up in terms of equity prices. NASDAQ was up 9.6% for the month of May. It was up 0.9% for the month of April and had been down 8% in March. So you see this topsy-turvy, and that's the theme of today. Apple, in May, Apple was down 2.2%. The year-to-date so far, Apple is down 21%. So Apple's not having that good a year in terms of stock price. NVIDIA, by contrast, NVIDIA was up 18% for the month, slightly positive, up 0.3% for the year, and up 22% versus a year ago. The big sales surge that was reported just at the end of the week, end of the month, NVIDIA reported a 69% year-over-year gain for the quarterly sales, despite having restrictions on what they could be selling in China. So that was very much positively reviewed and responded to by the market. You have basically a ping-pong ball tariff situation. Tariffs on, tariffs off. The courts stopped the tariffs. Then the appeals court stopped the courts. So you have all kinds of movement going on here. And let me just say, it's my opinion and our opinion that markets have become somewhat desensitized to all this. There's a whole sense of this is a lot tied up with the negotiating strategy of the administration. The court struck down his most sweeping tariffs, and then the appeals court struck down or paused the cutting off of the tariff. You had, for example, the 20-year auction that took place on Wednesday, the 21st of May. It did not go well. That got everybody very concerned. 1 week later, on the 28th of May, the 7-year auction went exceedingly well. And 78% of the demand for that came from international investors, which, as you may recall, in the month of May, people were wondering, well, are we finished with demand from abroad to put capital into the U.S. Treasury market? The trade drama, in our opinion, is not over. It is not over. You're going to have headline-driven trades. Just be prepared for that. You're going to have other headwinds on stocks. The S&P 500 is very richly valued at 22 times this year's earnings. Next month, and we'll start thinking about 2026 earnings, which are supposed to be up about 8-9%. We will see. First quarter GDP, the second issue of that number, 0.2% negative, 0.2% negative. The second quarter, according to the Atlanta Fed GDP Now forecasting tool, is supposed to be 3.8%. So a big jump. Part of it is the unwinding of the advanced buying that was done in the first quarter by people selling into the United States to try to avoid the tariffs. That basically led to a negative number on the trade, which caused the GDP number to be so low. I would say we want to watch these 10-year spreads versus the Treasury and the BAA corporate bonds. They're at 1.88%. They used to be about 1.5, 1.6%. We're watching those. If that gets up to around 2%, that's going to be reflecting investors' worries and investors' anxiety about a recession this year. Our call is for perhaps late in the year, and we're certainly seeing economic slowing. Maybe no recession, maybe a slight definitional recession. As of right now, that's where we are. As far as the Federal Reserve, they are on hold. The last week of the month of May, Chair Powell came and they released the minutes, and in the minutes, he said they're going to await further data on inflation and economic growth. So they're basically staying on the sidelines while all of this trade drama and tariff drama is playing out. The June 18th meeting, that's the next Fed meeting. Right now, the Fed fund futures markets give only a 5% chance of a 25 basis point cut from the 425 to 450 level, which is where it is now. The next meeting after that is July 30th, and that's expected to be a 27% chance. So still only 1 in 4 chance. Then you get to September 17th and then October 29th. September 17th, 73% chance right now. The Fed fund futures markets are saying at least a 25 basis point cut, maybe more. And we're okay with that. And then October 29th, an 89% chance. These are all as of now. There have been some signs of a hit to consumer confidence, some signs of a hit to corporate confidence. The labor market, though, remains reasonably strong. New jobless claims, continuing jobless claims. Retail sales for April were down 0.1% after March was revised upward to 1.7%. I think one of the key things that took place in the month of May was the Geneva meeting between Treasury Secretary Scott Bessent and his counterpart in Geneva, and that calmed things down. And I think that really helped the market do what it did, rising 6.2% for the S&P 500 and 9.6% for the Nasdaq. We want to say that gold was flat, basically flat. Dollars down about 8% for the year. We're watching that. That I think maybe has leveled out for the time being. Oil, 60.94 for the U.S. oil market versus 58. So oil was up a little bit in the month, and we're watching the supply-demand figures there. All of this we put together, and we see the need for portfolio dampening allocation right now. And this brings us to alternative investments, where we continue to like private equity, the secondary market interests, find good ones there. In the collateralized loan obligation for debt and collateralized loan obligation for equity, there you can get some good, decent yield and make sure you're in a good space credit exposure-wise. And finally, infrastructure and real estate are two other areas within the alternative space. Again, focusing on managers which have a good platform to do the proper due diligence and the appropriate selectivity. With that, we wish everyone a great month ahead. Thank you for being with us today.